The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, everybody, this is the Tax Lady, and we're going to get you ready because it's tax time, and we're going to talk about the old stuff, the new stuff, the phasing in stuff, the phasing out stuff, the things you got to do, because there are a number of things that you need to do so that this is all about your finances. So obviously taxes are a big part of your overall finances, and we want to make sure that you keep them. We want to keep the taxes whenever possible. But we want to make sure that if there's something you can do to tweak the way you're doing things so that you're still in the ball game with some of these changes, we're going to help you to do that. And we're going to talk about last year for deductions this year so that when you're doing your 2017 return, you can say to yourself, oh, I got to do something about that. So 803-0930, 803-0930, star 930 on the cell phone. And I have Tiff in the studio with me today. Hey, Tiff.
Hey there, Esther. Chris is training our staff right now, so you've got just me. He's over there teaching them about the tax changes and
that's right.
All that good stuff.
So our office is open on
the 19th, which is Friday. And so we're really excited. So they're open 9 to 9, and we're all geared up and ready and prepared for 17 and prepared for 18.
So even though the IRS won't let us send electronic returns, the great thing is you can come in as soon as you get your W-2s. We'll get you kind of in line, and boom, the day we can file them, we will. But by the way, your refunds are going to be held up until, especially with earned income credits and child tax credits, till well into February. And that's a new thing that we want to talk about.
Yep. And then, actually, today we were doing the training and somebody came to our door and we did a 2017 return not so long ago. We've been doing returns all week. And then,
but if they needed the money, there's a product that we have this year called Easy Advance.
That's right. Up to $2,500 of their refund they can have within.
No, not their refund. Right, based on their
refund, they could have within 24 to 48 hours.
Right, and it's interest-free, no fees.
Yeah.
So it's a really great thing. So if you're somebody that's going to need your money before they release it in February, you can come in and ask for the Easy Advance, and we'll make that application.
And then, interesting enough, we just one of our receptionists, our full-time receptionists at the main office, sort of was struck with an illness. So if anybody's looking for a full-time, part-time, seasonal
that would be
recept.
Fun. We would love, so if you're looking for a full-time, part-time job and you love people and you think that you're good at answering the phone, you like a hectic environment, but you love serving people, give us a call at 632-7886 and ask for Maria. And usually, we have our staff come back year after year. And this particular lady's been with us, but unfortunately got sick. So
that's right.
We lost.
Can I say that's bad timing? Can I say it's bad timing?
It was bad timing. bad timing. I'm Esther Gulius, the tax lady from EG Tax. 803-0930, 803-0930, star 930 on a cell phone. And we're going to we wanted to clarify the pass-through deduction for those of you. Now, the pass-through is going to be something on the 2018 return, but you're in 2018 right now. And so in your planning process, you ought to know what the pass-through deduction is.
Correct.
So if you have a real estate investment trust, if you have a subchapter S limited liability company, any pass-through entities, sole proprietorship, and you are single, or you're married filing a joint return. If you're married joint and your income, adjusted gross income is under $315,000, you're single over $157,500, you're going to get a 20% deduction after itemized deductions. It's a below the line deduction of 20% of your net profit. So if your net profit is $100,000 and you're a single person, $157,500, then you're going to get a
$20,000. You have to have profit.
You have to have a profit. Mm-hmm. You get a 20% credit on the bottom line.
Okay.
All right. However, if your income exceeds that $157,500 until it phases out at $207,500, and your and you're not a personal service business, and I'll explain that in a minute, then your deduction is 20% of your bottom line or 50% of the wages you pay, limited to the 20%. So if you're a Schedule C and you're a doctor, let's say, and you make $180,000, and you're starting off, you make $180,000, then you're under the if you're single and you're under the $207,500, then you're going to get a 20% deduction on your bottom line. However, if you're let's say you have widgets, you have a widget company in Cheektowaga, and your income is $400,000. You're not a personal service company, so now you'd get a 20% credit, 20% deduction on the bottom line, which would be 20% of $400,000, which is $80,000. But now, because it's over, if you're single, over $207,500, they now put what is your wages? And if the wages that you had paid were zero, you get zero deduction. So, but if you had wages of $100,000, you'd either get the 20% of the $400,000, which is $80,000, or 50% of the wages, whichever is lower, and so the wages would be lower. So that's real important that people that have pass-through companies, sole proprietorships, LLCs, LLPs, subchapter S corporations, real estate investment trusts. By the way, if you have a real estate investment trust, you get a 20% deduction on the net profit from the real estate investment trust as well. So, all those kind of things are really important. And so you want to make sure that if you're somebody that is self-employed, or you know somebody that's self-employed, that they talk to their accountant so that you can plan, because you don't want to miss this kind of a deduction.
Nope, not at all. It's really exciting. And you taught me, rightfully so, they lowered the corporate tax rate. So this is a tit for tat, a little benefit for the small business owner, because they lowered the corporate rate so much.
Right. So they took the corporate rate down to 21%. And so what they said was, we really want to give a break to the business owner.
Yeah.
And that's where this 20% comes in. But there's all these little apples hanging on this tree. And so if you do this, then you got to do that. If you do that, then you do that. But if you're a service corporation, then you don't. Then you're limited.
And I got to say, Esther, really, you've been ahead of the time. I called NATP yesterday for some clarification about what you just rattled off. And they're like, let me do some research and I'll get back to you. Let me do some research. So really, thank you.
I mean, that's part of, I think, what EG Tax really does is we really know taxes, number one. Number two, we really care, and we want to help you.
Yep.
So here's the thing. If you're a personal service corporation, company, that would be if you are an accountant, all right? If you do actuarial tables, if you do consulting, if you are in the health professional, like a doctor, dentist, podiatrist, where, basically it's your shingle outside. Lawyer, if you are a athlete, where you're a Buffalo Bill and they pay you on a 1099, but I know they get paid on a W-2. Or if you're a performing artist, that's just some of the categories that are personal service. If you're personal service business, subchapter S, then once you make over the 157.5, phasing out of 207.5, then it makes no difference. You will not get the 20%. So that makes you want to make sure that you do planning, because if you can reduce your net profit so that you stay under those limits, you'll get the write-off. So that's what it's so important that you talk to your tax advisor. And I will tell you, when you come into EG Tax, we're not only just going to do your 2017 return, we're going to say, okay, now this is going to change.
So you might want to get some Section 179 assets.
Right,
you might want to get some property, some
maybe
land.
Maybe you want to open up a pension plan,
right,
and put money into your pension plan for your employees. I mean, things of that nature, you know. Anyway, I'm Esther Gullius, the tax lady, 8030930, 8030930, star 930 on a cell phone. And you know we love you and we want to help you. So give us a jingle. We're going to take a short break, and we'll be back with your calls on the other side.
I like that, Frankie.
Hey, I'm Esther Gullius, the tax lady from EG Tax, 8030930, 8030930, star 930 on your cell phone. And I will tell you, if you have any questions about the phasing in tax law, call us. All right? We're happy to help you. If you got questions about 17, call us. That's what we're here for. But we do have a caller. We have Ron from Gasport. Hey, Ron, how can we help you, sir? Hello? Hello, Ron? Earth to Ron. I don't know if he's there. Well, okay, we'll just put him on hold, and if he ever comes back, we'll talk to him. All right, let's talk right now about this is the last year for several things when you're doing your 2017 return. And really, is he back on? Is he back on? Okay. No. Okay. This is the last year for several things. First of all, dependent and personal exemptions. Mm-hmm. I told this to everybody. As soon as they proposed this, they talked about doubling the standard deduction in 2018, but they took away the personal exemption. So this will be the last year you're able to write off your dependent children and your spouses and yourself.
Right.
And so this year it's $4,050 per personal exemption and dependent exemption.
That's right.
Now, on the new return, they're going to have to still deal with if you have qualified people living in your home, but they're not going to give you anything for them. So
$500, I thought.
Well, that would be the credit.
Okay.
But you're not going to get the deduction.
Correct.
The deduction went bye-bye.
But you're going to get a 5. Yep.
All right. So a family of 4 in 2017 gets a deduction of $16,080. But in 18, there won't be anything. Now, there is a family credit that they're talking about of $500. I don't know if it's $500 a person or $500 for the family. I don't know yet.
I thought it was for $500 per person, but we'll look into it.
Right. All right. The other thing that's going away is taxes over $10,000.
Right.
Now, when you itemize this year, and when you're doing your 2017 return, you can take your New York State withholding, your New York State estimates, any New York State balance dues that you paid. You can take your property taxes on how many homes that you have.
Right.
You got a home at the lake. You got a home in Buffalo. You got a home in Florida.
You're
can take
good
them
to
all.
go.
Right. And your if you didn't pay New York State sales tax, if you didn't pay New York State taxes, you can also take your sales taxes.
Right.
All right.
If you paid estimated payments to New York State, you could take those estimated payments, which is state tax.
Right. And you could also take any foreign taxes that you paid.
Correct.
All right? If you didn't do the foreign tax credit. So that's this year. Next year, all of that is going to be limited to $10,000. So I'll give you an example. Let's say this year you had New York State withholding from your W-2 of $4,000, and you have property taxes on your home of $6,000, and you have a vacation home with property taxes of $4,000, so that's $14,000. Next year they're going to limit it to $10,000.
Right.
So what I'd suggest you do, if the reason you aren't able to take the property taxes on your second home is consider making your second home a vacation home so that you start getting income from it so that the taxes are going to be, if not fully deductible, partially deductible. So that's something to think about.
Yep. As long as it fits the parameters of being a rental, then you're good to go.
Right. I mean, so what you're doing is you're saying, I wasn't renting it, but now I want to rent it, and this is the income I'm getting. And so you'll be able to deduct your travel to get there, your insurance, your utilities, your property taxes, all your repairs. And it may end up being a great investment for you in a different way. But the bottom line is, in 2018, you're not going to be able to take all those different kinds of taxes are going to be capped at $10,000.
I was planning with a couple the other day, and they had rental property, and they also had a personal loan on their house, and they had a home equity. So my advice was to get rid of the home equity because in 2018 they can't deduct that interest.
Right,
I know
we're going to talk about that. I'm Esther Golias, the tax lady from EG Tax, 803-0930, 803-0930, star 930 on a cell phone. Right?
Correct.
All right, because we'd love to talk to you. Okay, now, so Tiff, like you were saying about the home equity,
right.
If you're somebody with a home equity credit line, home equity loans are no longer deductible. On your 2017 return, it's good. But here it is, the 13th day of January in 2018. If let's say you have a primary home mortgage of $100,000 and a home equity of $50,000. your home mortgage of the 100,000 will be deductible, but your home equity of 50,000 won't. So what I'd suggest you do is refinance, if you're an itemizer, the two mortgages into one primary new mortgage.
Yep.
And again, there's a lot of questions you got to ask yourself. Am I going to live here for a number of years? What's the cost to do that? What's the rate that I'm paying right now?
Versus what you currently have.
And am I going to itemize, and what's the benefit? But next year, the only thing you're going to be able to deduct is your primary mortgage.
That's right. I remember one time, Chris and I, we wrapped our home equity into our primary, and the rate was better, and so we saved a lot of money. But like you said, you have to ask yourself all those questions, but it can be done.
Well, and then you might have, let's say that you don't even have a mortgage on your primary house.
Right.
You might have a mortgage on your vacation home. And if your vacation home is not investment, that interest is not going to be deductible anymore. So it's really important that you sit down and really think of these things, because next year is too late. And that's why I really wanted, every Wednesday, I usually think about the show on Saturday, and I try to think about what would I'd like to impart with people, so that they'll get it,
Because if you think about it, we're already halfway through January.
And by the time you close on your mortgage, you're probably going to be halfway through February.
That's right.
But the thing is, next tax season's too late, and it's just not going to be deductible. So I wanted to make sure we talk about that.
And I find this really interesting. These laws that you're talking about are here until 2025, and then it reverts back to what it used to be. Some of the stuff.
Yeah. I'm Esther Golias, the tax lady, 8030930. 8030930, star 930 on your cell phone, and we got Dave from Chaffee calling. Hey, Dave, how can we help you, sir?
I got a question for you for property taxes for 2018.
Yeah.
If somebody has a farm and also their home is located on their farm, the farm's a business, how would you allocate the property taxes for 2018?
Well, it's going to be the same as you always have done it, because you've always allocated your property taxes on your farm between your home on the farm might represent half of the total value of the farm, and the other half would go on the Schedule F. So the Schedule F is not going to change. Schedule C's aren't going to change. Schedule E's aren't going to change. So the way you allocated it, how you allocate it in 17 is how you're going to do it in 18. There won't be any difference.
I wonder, he has the $10,000 limit, so I wonder if he might want to look at what his property taxes are and allocate more for the business in 2018.
Only if he can justify it.
If you could justify it.
I mean, if you've been sloppy, Dave. I mean, if you've been, let's say you said, it didn't make any difference, I'm losing money on the farm anyway, so you didn't do the allocation properly. If on the farm, you'll be able to write off your loss if you're really trying to make money. So if your allocation hasn't been tightened up, this is a good time to find out how the city that you're in has allocated the farm income, the farmland, to the value of your home, so that you can make sure that you know for next year how much really goes to the house and how much goes to the acreage.
Right. If your home was a certain amount, then that was a percentage of your appraisal. That's what you're saying.
Well, I don't know. Find out how the town has you appraised. Call your town inspector and say, okay, you have my house assessed at my farmland assessed at $150,000. How much of it do you allocate to the house? How much do you allocate to the farmland and the outbuildings?
There you go.
And then you'd have a really good idea to hang your hat on, so that next year, let's say that they say, well, really, off of your $7,000 that you're paying in taxes, only $1,000 of it goes to the house, and the other $6,000 goes to farmland. That's what will go on the Schedule F, and you'd still get the deduction for it.
Good. Okay.
Okay?
Much.
All right, thanks, Dave. I'm Esther Golias, the tax lady, 8030930, 8030930, star 930 on a cell phone, and we're going to go to Sarah. Hey, Sarah, how can we help you, my dear? Hello? Sarah. Oh, okay.
They said to go to 2.
Go to 2. Hey, Ron, this is Esther Golias. How can I help you?
Hey, I have some questions about a race car deduction.
Sure.
All right. We just do it as a hobby.
Mm-hmm.
But over the last few years, we sat down and looked at what the expenses are, and I'm kind of getting really beat up as far as, what we've got invested. Is there a safe way to...
Okay. Well, first of all, in order for anything to be deductible, it has to be ordinary and necessary. So it has to be a necessary expense for the production of income. So number one, are you trying to make money, or is this a hobby?
You're never going to make money with a race car.
Okay, well, if this is just a hobby, do you get any purses?
Yes.
Okay, so the income is taxable and the expenses are deductible on the Schedule A. Okay, so you're able to take the expenses up to your income, but you cannot have a loss. And when it's a hobby, that's it. You can take your expenses up to the income. If at any point in time you become Mario Andretti or whoever the heck the best racer is in the country, and the race car gets a lot of sponsors, and you're now changed over to really making a living off of it, then it would be a horse of a different color. But right now, if it's a hobby, you have your income on line 21 and your expenses on the Schedule A up to the income.
Okay, so if my income from the race purses is $10,000, that's as much as I can.
That's exactly right.
Okay, so
and that's because the law says if it's just a hobby, it has to go on. You can't take it as a loss.
Right.
Okay, so if I was to make a business out of this thing.
Right, but again,
you have to have a profit motive.
You can't lose money for more than 2 out of 5 years without the IRS knocking on your door and saying, "Hey, Ron, you want to explain to us why you keep losing money on something that's supposed to be a bona fide business?"
All right. Mm-hmm.
Okay.
All right, but in that, you don't get a sales tax account with that either, right?
That's different. That's all. You want to hang on? I got to do news. You want to hang on?
Okay, all right.
Hey, hang on, Ron. I'm Esther Golias, the tax lady from EG Tax. We're going to break for news. 8030930, 8030930, star 930 on the cell phone. Well, I'm Esther Golias, the tax lady, 8030930, 8030930, star 930. Taxes are a part of all our lives, and I'll tell you at EG Tax, we want to help you to make sure you don't overpay your taxes. So if you got any questions on 2017, which is what we're going to be doing now here pretty soon, and 2018, the IRS is not open for. I already got the answer, Tiff.
Oh, you did.
The IRS is not open for business till the 29th. We're open on the 19th. We'll get all your taxes done. We got all the software and everything ready to go. We just can't send them into the 19th because I think the IRS is trying to catch up with all that's been dropped in their lap here recently. So, all right, let's go back to Ron quickly. So, Ron, you were talking about sales taxes. Sales tax is a New York State tax return, New York State return that you do when you collect money from sales of things, and you have to collect the sales tax for them. Why would you be doing a sales tax return?
Well, I was told, by some bench racers that you can get a sales tax. What am I trying to say? When you go buy parts, you don't have to pay the sales tax.
Oh, you can get an exclusion. You can get exempt from sales tax.
Right.
But if you're selling the race cars, then in other words, if it becomes part and parcel of something that's going to be sold ultimately, and then you're going to collect sales tax on it at the end, then you would be exempt from sales tax. Or if it's a capital improvement. So if it's capital improvement, or if it's part and parcel of something that's going to be sold, and sales taxes are going to be collectible at the other end. But I guess the best thing to do is call New York State and talk to somebody in the sales tax department and give them an idea of what you're talking about, and they'll make that determination whether you qualify.
Okay. Well, the reason I was asking that was the engines that we are going to use this year are like $20,000.
Right.
But of course, I got to pay sales tax.
Right.
Are you going to ever sell those cars someday?
Oh, probably, yeah.
And charge
but
sale?
He's not really doing it for resale.
Okay.
He's not doing it for resale.
So it doesn't.
Yeah, but
sound
I would
like...
suggest I don't think so, Ron. But I would call New York State. They don't know who you are. Tell them your name is Henrietta and ask the question, and they'll let you know. Okay. Better to be safe than sorry.
Okay. So would it be worthwhile for me to make this a business?
Well, but you can't because you keep losing money. You're not going to make money. You just said you're not.
Yes, right. But
so you can only lose 2 out of 5 years, and if you don't have a profit motive, they're going to disallow everything. So
I don't think so.
Right. And I don't want them digging around.
There you go.
Amen.
All right. Thanks, Ron.
All right.
Happy New Year. All right. We're going to go to Sarah. Sarah from North Tonawanda, who wasn't there before. Hi, Sarah. How can we help you?
Hi. I'm looking for the best way to finance a vacation home, and it turns out it would be the equity in my current home.
Okay.
So I'm going to refinance my home and get cash back from the bank.
Oh, if you do, it won't be deductible.
Well, that's what I'm calling to ask you.
So let's talk numbers. How much is your house in North Tonawanda worth?
$275.
And what do you owe on it?
30.
Huh, 30,000?
Mm-hmm.
Okay, so how much do you need to buy this new house?
100.
Okay, so why don't you just put a new mortgage on your house for 130? All right, pay off the first of 30. Now you got a new mortgage. It's going to be a lower interest rate than they're going to give you on a home equity, and it'll be deductible.
Oh, that's what I meant. I guess I explained.
Yeah, I thought you meant she meant she was going to get a whole new mortgage. I thought she meant that.
Oh, so you are going to get a whole new mortgage?
Yeah, I'll get a whole new mortgage.
Oh, yeah. I thought you meant a home equity you're going to get.
Oh, but will the money they give me be deductible if I get a whole new mortgage?
Yeah, if you get a whole new mortgage, you're fine.
But
now,
it's going to be hard to
the new
itemize.
mortgages are going to be limited to $750,000, so you're A-OK.
But it's going to be harder to itemize because they're doubling the standard deduction.
But it won't be taxed. That's all.
It will not be taxed. If you're an itemizer, it will be deductible.
Great.
Okay?
Thank you.
Thanks for calling back, Sarah. I'm Esther Gilius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. And we're going to go to Tom. Hey, Tom, how can we help you, sir?
Hi, Esther.
Hi.
I got a question regarding my home. A few years ago, I put my home in my daughter's name on the advice of my lawyer, one of these long-term plan things, planning for the future.
Sure.
And the taxes, my name is still on. I get the tax bill at my house. Obviously, I live there. But it's got her name on it, too.
Okay. Now, was it a life estate?
Yes.
Okay, so what's the question?
So the question is, the house in Rochester where she lives, where she does itemization.
Sure.
Can she use that taxes?
All right, it has to be your debt, which it is, paid with your money, and it's your money. That's when it's deductible. When it's your debt paid with her money, then it's when it's collectively your collective debt. If she's on the deed and she pays it with her money, then it would be deductible to her. But again, she's got that total cap next year of $10,000. So that would be state withholding and all property taxes. So it all depends on if she's going to come up over that $10,000 cap. But it's got to be her debt paid with her money.
Well, it's actually the house I live in. It's my family house, and I pay all the taxes.
Okay, then she can't take them.
Okay, that's the simple answer.
Right. So it's got to be her debt paid with her money.
Yeah. Okay.
Thank you, Tom.
Appreciate it.
All right, bye-bye. Let's see, we're going to go to Tom. Another Tom. Tom from Kenmore. Hey, Tom, how can we help you, sir?
What are you doing, Esther?
I'm doing good. I'm just sitting here talking to you.
Okay. I had bought about 20 years ago. I had purchased for like $1,500 a classic car.
Right.
And over 20 years, I put money into it, and over like $37,000 in receipts, and I sold it at one of the well-known auction houses in June, and I got like $45 for it.
Congratulations.
Yep.
Thank you. But now it's I don't have any proof that I purchased the car, for $1,500 20 years ago, because I gave that receipt to, motor vehicles when you registered the car.
But do you have like a record of all the money you put into it?
Well, yeah, I have all the receipts, that I.
All right, so let's say you paid the 15 plus maybe repairs of 20. So now your basis would be 21,000. So then you subtract that from your sale price, and that's going to be your capital gain.
He actually said you put 37,000 into it, right?
Oh, you put 37 into it?
Yeah, I bought the car for like $1,500.
So
And how much did you
8,000.
put into the car in repairs?
I have receipts for $37,500.
All right, so that would be $38,500. And what did you sell it for?
45. So that's
pretty-
7,500.
Did you pay anybody? Advertise? Did you have to pay a commission?
Yeah, they paid for all that. I wasn't going to release the car, but they paid for my commission and everything.
All right, so you got net dollars then?
Yeah.
All right, so like Tiff said, what's his game?
7,500, but I think he's worried about that $1,500 receipt that he doesn't have, and so
Well-
Esther always says no ticky, no.
Well, that's
washi.
true, but if you have anything that shows it was registered originally?
Well, no, not really. If I say that I got it for like $500,
No, I mean you don't want to lie. I mean, I would go with the correct basis, and in the event that I would think if you got all those receipts, the auditor would know that you had to pay something for it, and I would see if your verbal testimony would stand up. I would assume if you had everything, the $1,500 wouldn't be an issue, but but it'd be a crapshoot.
so all the receipts would be good, credited.
That's exactly right. Go to basis, right?
And what about the state? Do they accept the same thing?
Yeah, the state and federal follow through. So the federal government may not audit you, but the state of New York might audit you, looking at the basis. But again, you're talking about $1,500, and if somebody comes in with all the proof, and they know you registered that car at some point in time, they may be able to go back to their records and find out the basis. You'd be surprised what New York State has.
Yeah, that's true. Well, I just want to make sure I do everything right.
I understand. Well, if you know you paid that, then I would use it as part of the basis. If you don't feel good about it, then skip the 15, and your gain would be 9,000 rather than 7,500.
I've had it for 20 years.
Well, again, like I said, if you know you paid for it, that would be verbal testimony, and I think if you had all the other records, they would probably go with you.
Okay.
All right, Tom? Happy New Year.
Much for your help.
Thank you, dear. Bye-bye. I'm Esther Gulius, the tax lady from EG Tax, 8030930, 8030930, star 930 on your cell phone. And I will tell you, all of our offices are going to, most of our offices are open this Friday.
Yeah.
All of our offices will be open a week from Monday. The IRS is not open for business till the 29th. We're open for business on the 19th. We will get all your returns ready to go, everything signed, and boom, we'll get them sent. And since refunds are going to be held up, we have an easy advance.
Yep.
So
Product.
it's an interest-free loan. You might want to avail if you're somebody that needs some cash. Of course, we would rather have you change your your W-4 at work so that you don't get a big refund, but that's another discussion for another show. I'm going to take a short break. I'm Esther Gulius, the tax lady, 8030930, 8030930, star 930 on a cell phone. See you on the other side. I love spirited music. I'm Esther Gulius, the tax lady. It's tax season, and we want to help you. 8030930, 8030930.
Pretty soon you won't be listening to any music because
I have music in my heart. Okay, we got a full bank of calls, but let me quickly say this. Here's some other things that they're getting rid of. This is the last year you can take employee business expenses. So if you're an employee that's paying for travel, education,
union
supplies,
dues,
union dues,
work clothes,
anything, uniforms, it's not going to be deductible after this year. All right. So we're talking when you do your 17 return, you can deductible, not 18. So you need to have a conversation with your employer about having them reimburse you and adjust your pay. It'll all come out in the wash exactly the same, actually better for you because you'd save some FICA. And if you need that conversation, you can call us and we'll help you to talk to your employer. Brokerage fees are not going to be deductible anymore.
Correct.
And they really should add to your basis. I was just talking to Mike Lomas before he left the studio, and I said, so if somebody's paying you $10,000, that really should go to their basis.
And he said that's
and
a great
he said
point.
that's a great point, and we need to keep track of that. So you need to keep track of it. Other investment expenses. Maybe you bought the Journal and
Lawyer
have all
fees,
these things.
if Social
Lawyer fees
Security.
if you needed an attorney.
Yep.
It's not going to be deductible. Moving expenses are not deductible. Continuing education, again, next year, not deductible. So all of these things you need to think about. But what is new is in 18, there's an increased child tax credit, increased standard deduction, but of
And
course you're
how
losing-
about if you get to take your gambling losses, you also get to take transportation to fly to Las Vegas, Chris told me.
Yeah, okay.
Yeah, which I think
Right.
is just bewildering.
All right,
with the
and then
bus.
pass-through deduction for REIT, reduction in corporate taxes for C Corps, and new repatriation tax and increased depreciation. And that's just the icing on the cake. But we're going to talk to everybody here. All right, we're going to go to Bob in Niagara Falls. Hey, Bob.
Hello, how are we doing?
Good. What can I do for you, sir?
Okay, my fiance bought
Yep.
the house through her family
Okay.
with a home equity loan.
Okay.
We're trying to figure out, we're considering selling it.
Okay.
Well, how would we figure out the tax on it?
Okay. Well, first of all, if she buys the house from the family and sells it, how long did she own it for?
More than 10 years.
Okay. Did she live in it?
Yes.
Then it's going to be completely tax-free, unless was it rental property?
No.
Okay, so if you lived in a home 2 out of the last 5 years, then the first $250,000 in gain is tax-free if you're single, $500,000 if you're filing a joint return. So she's not going to have to worry.
She's going to be happy.
She'll be a happy lady.
Yes, because when we're using that to buy a new house and move up.
Yay, good for you, but it'll be tax-free.
Okay, very good.
Thank you, Bob.
Call your real
Thank
estate
you.
agent and look at some
All right,
houses.
and then we got Dan. Hey, Dan, can we help you, sir?
Yes, good afternoon. Question on the alimony deduction. I understand it's going away in 2019.
Right.
If you're presently paying alimony as far as a date of action in 2016, would you be grandfathered in?
Yep.
That?
Yep.
Well, okay, so that won't go away.
Right. That was a real kicker, I'll tell you.
So
I mean, people that are doing divorces, if they would have gotten rid of it completely, you would have thought to yourself, my gosh, these are people that said, I can afford to do this because it's tax deductible. But if it's not tax deductible, whoa.
So, in other words, if your divorce is finalized in 2019 going forward, then you can't deduct it.
That's right. But the old ones
Yep,
are grandfathered in.
So this gentleman is okay.
So if you are paying alimony, you're good to go.
Okay, thank you very much.
Thanks, Dan.
Very
Thanks for
important.
waiting. Okay, we got Michael. Hey, Mike, how can we help you, sir?
Hi, how are you doing this afternoon?
Good. It's chilly. I'm going to tell you. Last night we had an employee banquet up in Niagara Falls, and it was like, whew.
It's cold. Snowing. My daughter is here, and her boyfriend is from California, and he says he's never seen so much snow. It's just snows a lot. It has been snowing a lot.
It is. It's a winter wonderland. But anyway, I'm sorry, Mike. How can we help you?
Oh, that's okay. I have a daughter in Miami, and they've had down there.
Yeah. Yep. There you go.
It was cold to them. Winter jacket.
Yeah, that's true.
And my question is, I'm looking at maybe selling stocks. I mean, like in the $80,000 to $100,000 range. We're just two blue-collar workers here. We make maybe $100,000, just over $100,000 gross. And I wanted to possibly use these stocks as a loan to two of my children.
Okay.
Is there tax? I know there's capital gains tax.
Right. Well, first of all, people talk about capital gains tax like that's a really bad thing. Wages, there's ordinary income, and then there's which is taxed at regular tax rates. But capital gains are taxed at preferential rates. They're a cheaper way to pay taxes. So I don't know what you and your wife are making as far as income goes.
80 to 100. He said 80 to 100.
That's what you guys make, right?
That's what I was planning on selling. We make just over probably maybe 120,000, 110, 120.
Collectively, right?
Yeah, excuse me. Yeah, that's right. The stock sale was 80 to 120.
Okay, so you guys are in the 25% bracket, which would mean that you would pay 15% on the gain. All right? Okay. So if you sell 80,000 in stock, what did you pay for it?
Okay, that would be. I'd have to figure that out.
Give me like a ballpark.
Probably. I'd say probably 50,000.
All right. So if you had a $30,000 gain at 15%, it's going to cost you $4,500 in federal taxes and about $2,100 in New York state taxes, or $6,600 total.
And then don't forget to add to your basis all those dividends that you've paid taxes on and all those capital gains throughout the years, too.
Right.
Oh, okay.
So in other words, make sure you have the correct basis. So you might have paid 50, but you had all those reinvested dividends, and the reinvested dividends move that up from 50 to a higher number, which you then use to offset the gain.
All right. Reinvest. Now, as far
But all right, so now let's say that you then give that money to your kids.
Correct.
Right? So the gift of money to your kids, you're going to have to do a gift tax return, but it's not going to be taxable to them or deductible to you. And that's it. Unless you loan them the money and they start paying you interest.
Okay, they have to pay me interest if I loan them money?
No, you don't have to collect interest. You don't have to. But if you do loan them and you do charge them interest, then the interest is going to be taxable to you.
Taxable. Oh, all right. All right. Very good.
All right. Thanks, Mike.
Thank you.
Bye-bye. And let's go. That's how parents are.
Yep. And that's a really good question. And the best thing is that he's asking questions prior to the transaction.
I have to tell you, if I could only be in people's kitchens while they're making all their plans, and I could say, wait, let's think of this way. Let's do it this way. Think of a different way. Because sometimes just modifying what you're going to do can make all the difference in the world. Okay, let's go to Dave. Hey, Dave.
Dave
in Niagara Falls.
You can hear me?
I can hear you. Can you hear me?
Gas station right now. That's why I want to make sure you can hear me. Okay.
Yeah.
My wife is.
Well, you seem to be breaking up. Are you on a cell phone, Dave?
I am. Better if I sit.
All right, that's better.
Okay, I'm going to sit still.
Oh, that's good. Just sit there.
Okay, we have a business. It's in my wife's name because it's a minority-run veteran business.
Okay.
We run a pilot car business for oversized loads. We transport oversized loads all across the United States.
Okay.
So we're under the same rules as the trucking industry.
Yep.
My wife is drawing Social Security right now.
Mm-hmm.
So she is limited to 50, I believe, in profit from the business every year.
I didn't hear the number you said because you cut out.
I think he said like 15,000 because maybe she's not at full retirement age.
How old is she?
She's 62.
Okay, all right. What you're saying is that she's collecting her Social Security and she's limited in the amount of wages she can collect before she has to start paying back some of her Social Security.
Correct.
Okay.
Now, the money we generate from the business, profit after all our deductions, that's considered income for her and wages?
All right. All of the net profit from the business, if the business is in her name, is her earned income, which would then affect her Social Security.
Okay, now,
limit.
Planning on doing, I'm the one out on the road making the money. She runs the office.
Okay.
I'm the one generating the income. I want her right now.
Wait, you cut out again. Are you there?
You hear me?
Dave, okay, what did you just say? Sit down. Don't walk around.
He said that he's out on the road.
I understood that, but then he said something else.
Okay, this year we're programmed to make, in 2017, we're programmed to make $28,000 profit.
Okay, $28,000. All right.
Which is more than the 15. So I'm going to have her 10.
Okay, no. Here's what you do, Dave. So why not have your wife pay you a W-2? Because you're out working anyway, and you should be getting part of the income. So your wife has the business, and have her pay you on a W-2. Then on line 7, you'll have your W-2 that you made from the business, and her net profit that will then go down under that $16,000 figure, so she doesn't have to pay back any of the Social Security. That's what I suggest that you do. And it's very simple to do a payroll, and you can give us a call, and EG Tax will help you with the payroll. But I think Dave is gone, and I can't hear. I can't be hearing you anymore,
I would
Dave.
call our office at 632-7886 for clarification of the question.
Right. I mean, because we're doing. But here's what he was saying. If you're under full retirement age and you're collecting Social Security, if your earnings exceed like $16,725, I think it's like this year, then you have to pay back to the Social Security Administration each dollar that you earn over that every $2 you earn, you have to pay back $1.
Correct.
So he doesn't want to do that. Well, the simplest thing to do is to reduce her net profit. How should she reduce her net profit? He's working for her. So have her pay him on a W-2.
That seems pretty straightforward.
Then he's got a W-2. He claims the income, but it isn't her income, and life is good.
Right.
Right?
That's right.
All right. Well, I'm Esther Gullius, the tax lady from EG Tax.
And there's
if during the week you have any questions, you can call us. We have real people answering real phones, and we want to help you. Our phone number in the branch office is 632-7886 at our corporate office. And all of our offices will be open this Friday, Friday the 19th. And again, if you need your refund, if you need your refund money in advance, we have the Easy Advance, and that'll help you soothe the savage beast. It's a no interest, no fee, basically advance on your tax refund, because they won't be sending refunds out until at least mid to the end of February, because they're not even open up for business till the 29th. But we'll get you going. We'll get you settled up. If in the week you're sitting up in the middle of the night and have a tax question, email me through my website at Ask the Tax Lady, EG Tax, and I'll email you right back. Until next week, stay warm, people. I love you very much. Happy New Year. I'm Esther Gullius, the Tax Lady. Talk to you next Saturday. Bye-bye.